All right, welcome to Accounting for Partnerships. Let me go ahead and share my screen so we can see the slideshow. All right, there we go. Okay, so accounting for partnerships, this is a lot similar to what we're used to doing with accounting for sole proprietors that we've been doing pretty much from chapters 1 through 10, actually 11. We've been focusing primarily on accounting for partnerships, or excuse me, sole proprietors, but now we're going to start looking at partnerships, okay? Next slide. Come on, there we go. All right, learning objectives. You can pause and look at that as much as you'd like. So let's look at the partnership organization. All right. First of all, you have this voluntary association. Nobody's forcing you to. But there's also all these other things that we need to consider. Taxation. Partnership, like a sole proprietor, is a flow-through entity. That means that this taxes are going to go to the individual owner and their tax rate and their tax situation, as opposed to being taxed at the entity level like a corporation would be. The partnership agreement is what forms the partnership and sets all the rules and requirements of each partner in that. Like the sole proprietor, it has a limited life. If one of the partners dies, leaves the partnership, or in any way leaves that agreement, then the partnership is dissolved. Even by bringing on a new partner, if all the other partners stay the same, that new partner will dissolve that old partnership and form a new one. While there is limited liability, there's also mutual agency, which means either partner or any of the partners can bind the partnership into a contract. So mutual agency is kind of something you want to be careful of, especially if you have someone that thinks that your partnership can do more than you really should. So it's kind of a scary thing, but there is co-ownership of property as well in this. It's a little different than sole proprietor, where the sole proprietor owns everything. My experience and my thoughts is that a partnership should never be formed. There's just so many disadvantages to it that I would never form one. Here's your chart of different organizations. You can pause this and look at this. This is kind of a good general information as far as what you'd look for. But you do have several different partnerships. You have this general partnership, the limited partnership, and limited liability partnership. Know those differences. S corporation, you're going to kind of see it's similar to that, except it's pretty much the same as a C corporation with some differences as far as the tax purposes and other things. And tax treatment changes over the years. In fact, we just had a lot of changes because of COVID and stuff like that with how they're taxed. So choosing a business form, you wanna just get with, honestly, you just want to get with a lawyer and explain that what you want, what your focus is going to be to form your business entity. Okay, maybe a partnership in your situation might be great. Maybe that's what you want. But maybe an S corp is better. Okay, just different things you want to look at and consider. But my recommendation is go to someone, unless you're going to be that someone, go to someone that deals with this all the time. Pay that little bit of money that you got to pay to have it done right. Okay. So when we do this, when we're looking at all of these formations and everything that's happening from the accounting standpoint, okay, there could be legal ramifications, legal situations that would change what the accounting treatment would be and everything, but we're going to look at this generally speaking from the accounting perspective, all right? When you form a partnership, as long as the agreement says that you can do this, these things are things that you can do. You can bring in assets and liabilities. You're going to record them at fair market value at that time, because if you bought a piece of land in downtown New York back in, or your property or whatever entity is forming this partnership, bought land in downtown New York in 1910 for like $10,000 and it's worth 2 million now, you don't want to bring it in at cost. You want to bring it in at fair market value. That just makes sense. So you want to make sure that all that is counted at fair market value. The main difference between a sole proprietor and partnership income, it lies here, is that the difference is that you have these partner capital accounts and withdrawals accounts. Everything else is literally the same, except you're going to be having these two different partner capital accounts, or three or four, however many partners there are. And then per the partnership agreement, we're going to distribute these the net income or loss to each partner. So, and there's different ways we're going to do that. We'll look at that. Organizing a partnership, you guys can look at this. I want to get to just the accounting stuff. So here we have a couple people, Kyla, I'm not sure how you say that, but Kay Zane and Hector Perez organize a partnership called Boards. Okay, Zane initial investment is $7,000 cash, $33,000 in boarding facilities, and a note payable for $10,000 on the boarding facilities. And Perez just brings in $10,000 cash. That's it. So we're going to look and see that when we do our journal entry here, we're going to debit whatever assets they're bringing into the company. We're going to credit any liabilities they're bringing into the company. And then the difference between the two are going to be the capital accounts. So in this situation, although Zane is bringing in $70,000 or $40,000 worth of assets, they're also bringing in $10,000 to liabilities. So they're only going to have $30,000 in their capital account. Whereas Perez is bringing in $10,000 cash straight up, so that's in Perez's cap account. This forms the partnership from the accounting standpoint, okay? Straight up, whatever, that's how it is. Now, how are we going to record income and loss among the partners? What do we need to do, okay? First of all, we have three frequent methods that we're going to use: stated ratios, capital balances, and then we're going to do this little mix thing and how to calculate salary, interest allowance, and any remainder according to a fixed ratio. And again, all of this should be spelled out in the partnership agreement. However, if there is no partnership agreement on how you allocate both income and loss, whenever it's silent, it's 50-50, 33, 33, 33. If there's three, basically you break it out evenly if there's no statement on this in the partnership agreement. So in this case, we see since, per the partnership agreement, they said Zane would receive 2/3 while Perez would receive 1/3. So if their income, I do have this thing where I have a hard time breathing, and so my body yawns and makes it. I'm not tired. My wife always tells me, you have to breathe. So anyway, the partnership income is $60,000. We're going to allocate 2/3 of that to Zane and 1/3 of that to Perez. All we're going to do is take that $60,000 and multiply it by that fraction. We have that 2/3 here times $60,000 and 1/3 times $60,000. And that's going to break out that Zane's capital is going to increase by $40,000 and Perez's capital is going to increase by $20,000. This is a stated ratio. That's the ratio, 2/3, 1/3, okay? That's the ratios that we're looking for. Now let's say if we're going to do it about based on their capital balances, all right? Well, we look at their capital balances, okay? So $40,000 of the balance is what we have in the total capital part of the company. So we're going to give 30,000 divided by 40,000. That's going to be 75%. So of this income, 75% is going to go to Zane, and the remaining amount, 25%, 10 divided by 40 is going to be 25% times 60,000 is going to be 15,000. We see that we add that up to get to 60,000. So in this situation, it would be Perez's interest to do the stated ratios because he was getting more in that situation. Then there's a three-step process that we're going to focus on here too. Maybe Zane or maybe Perez are going to work this company and they feel like, hey, I should earn money as I work this, especially like, let's say Perez, he's like, well, I'm going to work like, 20 hours a week. Whereas Zane's like, I'm going to work 30 hours a week. So we're going to pay Zane a little more than Perez. And then maybe we agree, hey, interest on our capital accounts will be at 10%. So whatever's in your capital account, whatever it is, we're going to give you 10%, kind of like as an interest payment on that. And then any amount that is remaining, we'll allocate it equally. So we're going to follow this three-step process. And I'll show you how to do that here. This is kind of what we're going to look at. We're going to make these columns. We have Zane on the left, Perez on the right. We're going to start off with our total net income, which we have said is $70,000 at this point. And then we're going to allocate those salary allowances, $36,000 to Zane, $24,000 to Perez. Now, typically what we're going to do, I'm going to pull up my calculator because we want to monitor this. we're going to go through and figure out and make sure that, because sometimes we may be allocating a loss at the end. So we're going to take the 70,000 and we're going to subtract out the 36,000 and the 24,000. That's going to leave us $10,000, okay, that we need to allocate based on interest now. So interest is going to be 10% of each of their capital accounts. So we're going to give 3,000 to Zane and 1,000 to Perez for a total of 4,000. So that's going to leave us $6,000. That's where we get it down to here. So we've allocated so far to Perez 25,000 and 39,000 to Zane. The remaining we're going to split equally. So 3,000 to Zane, 3,000 to Perez at the end. 42,000 goes to Zane and 28,000 go to Perez. Just how the partnership agreement worked out. Now, what happens if it's 50,000 instead of 70,000? We're still going to do everything at top, the salary allowance and the interest the same, except by allocating all this at 64,000, now we've incurred a loss. It's not a real loss. It's just that we overpaid per the partnership agreement to our partners, and so now we're basically saying, hey, we got to cut some of that out from you, okay? So as we do that, we're going to do that equally. 14,000 divided by 2 is 7,000 piece. So we're going to take 7,000 out of each of their capital amounts that we've already allocated, and that's going to get us to where we equal our 50,000 of our net income. And you will be working on something like this in the homework, so don't worry, you'll get some experience on this. So at the end of all that, our capital balances looks like this. Zane has 52,000. Perez has 26,000, and it shows there on that second to last line there that each partner withdrew something from the company. Okay, so the percentage, the interest allowance, is an incentive to have partners keep their money in the partnership, because if they keep pulling it out, it'll make the partnership have a difficult time to maybe expand or do what they want to do. So that's what the interest allowance is it's an incentive to keep that money there, because you'll get more interest off it. So it didn't show here, which I'm sorry it didn't. I thought it would. The journal entry that you're going to want to record to show this, you're basically going, now remember when we were dealing with the income statement in Accounting 111, we had our revenues. We'd close it out to our income summary as a credit to income summary, debit to revenues. We'd close out our expenses with a credit to expenses and a debit to income summary. We'd net those out. If it's an income, it's going to be a credit. If it's a loss, it's going to be a debit. So when we record this, if it's a overall gain or net income, in this case it was 70,000, then we're gonna debit the income summary 70,000, and then we're gonna credit each account by whatever we calculated. In Zane's situation was 42,000, Perez 28,000, and that's what our journal entry is going to look like. So now, what if these two partners decide they want to add another partner? Okay, we could do it in several different ways. Basically, the bottom line is we dissolve the old partnership, we form a new one, and then however that partner is going to jump in, whether they're going to invest assets and just be another partner now, or if they're going to buy a share of the other partnership interest, will depend on what we're going to do. But those are the two ways we're going to do it. So if someone purchases the partnership interest, basically in this case, Perez is selling some of their interest to Rashid. Okay, so Rashid is going to buy $13,000 worth of the capital in this partnership, and so we're going to have to do a new partnership agreement. We're going to have to figure out how to allocate, whether it's stated ratios, brain just farting here, stated ratios, capital balances, thank you, or the three-step process we just did. So in this case, buying the partnership interest, we're going to debit the partner that's selling and credit the partnership that's buying for the amount they purchased. Now remember, this says that about 1/2 of Hector's partnership interest for 18,000. So Perez is going to give half. He has 26,000, so he's giving up half. He's giving 13,000 to Rashid. You're not seeing the additional, what is that, $5,000 that Perez got from Rashid to jump into this partnership. And the reason for that is because that's a deal between Perez and Rashid. from the accounting standpoint of the partnership, we are only looking at the fact that we're giving half of Perez's partnership interest to Rashid. And that's all we're going to do in this situation. So don't get hung up on that. Now, what if they just admit after they bring in some assets? Let's look at it this way. Let's say that just Rashid contributes $22,000 worth of assets. Basically, what that does is it kind of waters down Zane's and Perez's percentage of the company owned based on whatever money they brought in. So Rashid brings in $22,000 cash, $22,000 into the owner capital of Rashid, and we just move forward from there. It's simple as that. So if what happens when you bring in more assets than what you're going to give to the new partner? Well, or less. It depends. From the standpoint of a partnership, if the partnership is like, we need you, please come in here, they're gonna say, well, what incentive are you going to give me? He says, well, we're going to give you 30% of the equity, but you're only gonna have to pay in 25,000% of what the equity is. So you're basically gonna get bonus 5,000. Or if the new partner's like, please let me in, they're like, all right, you're gonna pay more for it though. Kind of what we're looking at here. So in this case, on January 4th, Zane and Perez agreed to accept Rashid as a partner upon his investment of $42,000 cash in the partnership. Rashid is to receive 25% ownership interest in the new partnership. Any bonus is attributed to the existing partners and is shared equally. So in this case, we have $78,000 right now with the total partnership. So when we go and add in the $42,000 invested by Rashid, we have $120,000 of partnership equity. Multiply that by 25%, and that is what we're going to give to Rashid. But Rashid gave us $42,000, so that's $12,000 in excess of what Rashid would have got if he just kind of got that straight deal. So we're going to take that $12,000 and distribute it equally among Zane and Perez. They're both going to get $6,000 in their capital account. So we see here that the journal entry is going to be a debit to cash of the $42,000. Rashid gets the $30,000, and then Zane and Perez get $6,000 apiece as a bonus. And you can imagine that the difference, what happens on the flip side, if Zane and Perez are begging Rashid to come in, they're going to have a debit to their capital balance so that the capital amount that Rashid has will be exceed the amount of assets brought in. So let's look at that. If Rashid was going to bring in 18,000 and still get 25% ownership of it, still promised the $24,000 because as you add those together, 24,000 is the 25%. But Rashid only paid 18,000. So we got was that $6,000 more to cover. So we're going to take that equally out of both Zane and Perez. $3,000 out of each of their capital accounts is going to go to Rashid, and you're going to see Rashid with the $24,000 of their account balance. Okay, so what happens with partners decides to withdraw? Again, it depends on the circumstances. If maybe the partner's like, look, I want to cash out, I want to be done with this partnership. The other partners are like, look, we need to not do this, and there's some dispute. The partner that wants to get out may say, look, I will take less of my assets out if you'll let's just be done with this. They'll say, okay, so that'll be a bonus to the remaining partners. Maybe the other two partners are sick of the shenanigans of the other partner and want to just break off on their own. Then they'll try and buy the other partner out, and a lot of times give that partner a bonus just to get rid of them. So let's look at that. Basically what I just said, we'll go over that here. All right, so when Perez decides to leave, Perez has 38,000, Zane has 84, and Rashid has 38,000. Okay, so the partners share the income and loss equally. Perez has to receive 38,000 cash upon withdrawal from the partnership. Perez, this is just if there's no bonus. Perez is debited the capital balance, gets the cash, and runs. Oh wait, no, it gets out of the partnership. If there's a bonus to the remaining partnership, Perez is to receive $34,000 cash. Perez says, look, I'll just give you $2,000 each. I just want to get out of here. You guys have it. I don't care. All right. So he takes $34,000. His capital balance is zeroed out at $38,000, and the remaining $4,000 is allocated equally to the remaining partners, Zane and Rashid. On the flip side, if Zane and Rashid are trying to buy out Perez, and Perez is like, fine, but you got to give me some more money, they say, fine, we'll give you $38,000. All right, Well, now we're paying you 40,000, but your capital balance is only 38. We're going to pull 50% of that remaining 2,000 out of each of Zane's and Rashid's account, and that'll count for $1,000 each one. All right. If the partner dies, again, this is going to be in the partnership agreement as to what would happen. More than likely, the partnership would, well, no matter what, it dissolves. But the amount that is in the deceased partner's estate will can be bought out by the other two remaining partners or whatever remaining partners, and the estate goes to whomever the next of kin is. There's a lot of things that could happen and stuff like that. I'm not going to get too involved in the preparing entries for partnership liquidation. The bottom line is it's not cut and dry like you'd think. Like, well, they had $10,000 worth of equipment. We're just going to debit or credit $10,000 worth of equipment and cash it out somehow. A lot of times, well, not a lot of times, every time. Remember, we're using like straight line depreciation or other methods that are simply estimates. The fair market value is not going to be the same as book value, and so you're gonna see that if you have a car that's a nice car, hasn't been driven a whole lot, but it's been depreciated half, but the Kelly Blue Book has it as like 75%, that's going to be a better deal than if they got a machine that's like on the left part of its life, and what are you going to do with that? So there's going to be different things that you're going to want to do. But bottom line is that the partnership dilution must be done to where there's no remaining debts in the partnership. You're going to have a gain and loss on all liquidation of the assets, and then the liabilities to pay the partners, all the liabilities get paid. If there's anything remaining, it's distributed in cash to the partners based on in this case, their capital balances. It could be anything as long as again, we teach you this stuff, but if the partnership agreement says it's going to be based on time in the partnership, it could be anything. It'll be based on that. But here we're going to say it's based on their capital balances. If there's liabilities left over, like you didn't have enough liabilities, then the partners are going to have to owe the partnership to pay out and finish paying off the liabilities. Because remember, these individuals, while there might be some limited liabilities, there's still a flow-through entity, and it's possible that they can have, depending on the type of partnership, can have their personal assets seized. So if there's no capital deficiency, they all agree to dissolve. The liability is the accounts payable of $20,000. You see here that all the asset accounts versus the capital accounts, they're going to sell the land. Or maybe one of them will say, "Hey, I'll take the land and pay $8,000 on the accounts payable," and then and then some of the cash. It could be anything of what they agree. But let's look and see what we're going to do here. So in this case, we're going to liquidate the land. We're gained $6,000 because of appreciation. Again, that could have been just as easily given to each of one of the partners as part of the payout, but in this case, we sold it. So that $46,000 is going to be the land just converts back to a cash asset for the $40,000, and the remaining gain will be allocated equally to each of the partners in the sum of $2,000 per. Then we cash out. We take the cash, and then we take their capital balances, and then we add it all up. We get our ratio, and then allocate it based on that ratio of capital balances, basically. So take 72,000 divided by 204, and you're going to have how much? Instead, just above that, we paid off the $20,000 of the liability we owed, and then the remaining cash is distributed. If there is a capital deficiency, then they need to pay into the partnership. So in this case, Rashid had a $3,000 in the hole capital balance. Okay, this is uncommon, but can happen. What's going to happen is Rashid is going to add $3,000 to get to a zero, and that will deter the deficiency, basically. If that's what happens after all the stuff has been distributed, they need to pay that amount to get it back up to where it should be, and then Zane and Prez are paid out based on that. Partnership can't pay, then it's allocated equally to the other two partners as a loss. And then, they send Crusher and Low Blow to Rashid for not having enough money. No, I'm just kidding. They don't do that. But you see the journal entry here. This is kind of like I said, where things are just different than regular sole proprietor accounting. You're gonna just you don't see a lot of this happening mainly because there's only one capital account, but you're crediting Rashid Capital for the 3,000 to get it to zero, and you have to allocate that loss basically or that deficiency to Zane and Perez. And then Zane and Perez are given the money based on their ratios. And it's not going to change when it's shared equally. It's not going to change the ratio really for Zane and Perez. They're going to get whatever's left anyway. Um, compute partner return on equity. Okay. All right. So this is just kind of a no. We don't really care much about this one. Just kind of no partnership net income divided by partner average equity is going to get you your partner return on equity. So that's chapter 12. We kind of went through it. It's not a long chapter, but there's a lot of little chunks that you're going to know. I would say focus on making sure you know how to allocate income based on stated ratios, percentage of capital balances, and then the three-step process of the salary, the interest allocation based on their capital balances, and then the stated ratio at the end. Remember, it doesn't always have to be 50-50. It can be 60-40, 70-30. It does not matter, okay? All right, your word for this video is Scott, S-C-O-T-T. Again, that is S-C-O-T-T, Scott. For those of you military and law enforcement type, it is Sierra, Charlie, Oscar, Tango, Tango. All right, you guys have a good one, and we'll see you guys in the videos and other places. Take care.